Statements and consolidation of a foreign subsidiary. Assume that your company owns a subsidiary operating in Great Britain. The subsidiary maintains its books in the British pound as its functional currency. The relevant exchange rates for the US value of the British pound are as follows. Then we have our rates listed. For all parts of this problem, use a negative sign with your answers to indicate a reduction. Translate the subsidiary's income statement, statement of retained earnings, balance sheet, and statement of cash flows from British pounds to US dollars, assuming that the beginning of year retained earnings for the subsidiary is $2,926,035. Round answers in the US dollars column to the nearest whole number. So we'll start by just plugging in the rates that we're going to use. We'll use the average for sales, and I'm going to make this absolute so that I can copy this down. Because that's what we'll also use for cost of goods sold as well as our operating expenses. For dividends, we'll use the dividend rate. I'll just do these ones really quickly. So we'll use the round function, sales times the translation rate, and we want no decimals. And so I guess we could have copied that down. So we've translated our sales and cost of goods sold, and then we'll just come in and add our sales and cost of goods sold to get gross profit, and then gross profit and our operating expenses to get net income of $652,680. Then our beginning of year retained earnings was given to us up here, $2,926,035. And I'm going to make these comma so I can see the numbers better. Our net income we just calculated is the 652. Then our dividends, we'll multiply our rate by the dividends, and then we can use the sum function. Okay, now we come down to the balance sheet, and so we'll be using primarily the end of year rate, the $1.52. We want to put the dollar signs here and make this an, an absolute cell reference so that we can copy that, because that'll be for all of our assets and these liabilities. And then for common stock and APIC, we'll need to use the historical rate. And so we'll multiply those together, and I should have used the round function. And then we will do a sum to get the total assets. And then same thing, actually we can just copy and paste this formula down. All right, and then our retained earnings, we calculated up above as $3,512,565. Then we know that our total liabilities, I'm going to make A a little bit bigger. We know that our total liabilities and equity have to equal our total assets, and so we can do a plug here for our cumulative translation adjustment. And so that'll be our total liabilities and equity minus the sum of what we already have here for liabilities and equity to get a $62,748. Then we can come down to the statement of cash flows, and so I'm going to copy this average of $1.48 down. For the change in PPE, we'll use the PPE purchase date rate of $1.49. For the change in long-term debt, we'll use the long-term debt borrowing rate of $1.49. Dividends, the dividend rate of $1.50. And then beginning cash, we'll grab the $1.45 from the beginning of the year, and our ending cash will grab the $1.52 from the end of the year. Then we'll just do our multiplication. So our net cash from operating activities, and I actually think it's easier to insert a row here so that we can see the end of each type of activity. And so for investing, we only have this one activity, so we have a net use of cash. And then we'll do our change in long-term debt and our dividends. Add those together to get, insert this row, that we've had financing activities that provided $242,995. And it did technically tell us to round these to a whole number, so we should use equals round in these functions. All right, so then the net change in cash, we'll just grab the operating, investing, financing for a total of $375,337. And then our beginning cash and our ending cash, and we can use that to calculate the effect of the exchange rate on cash. And so our ending cash, minus the beginning and the change, excuse me, gives us $55,558 in the effect of the exchange rate on cash. So then the next portion of this tells us to compute the ending cumulative translation adjustment directly, assuming a beginning of year balance of $102,848. What journal entry did the parents make as a result of this computation? And so we start this out with the beginning of year net assets times the end of year minus beginning of year rate. And so what's a little bit funky about this is that we don't have beginning of year net assets directly. We can calculate net assets from the balance sheet, but that was the end of the year. But we do have the statement of cash flow that indicates the change, so we can use that to calculate beginning of year. So over here on the side, let's calculate our beginning of year assets and liabilities so that we can calculate net assets. And so cash, beginning of year cash, is going to be equal to the $642,600 that we have down here at the bottom of the statement of cash flows. Then our accounts receivable, we'll take this end of year accounts receivable and add the change for 609, and we'll continue to do that. Our inventory, and then just pay attention here because the next item on the statement of cash flow is liabilities, but we're looking at PPE here. So we'll take our PPE plus the change in PPE. And so we can do a sum to get total assets of $3,608,000. Then our current liabilities, that $534, and our change in current liabilities. And that should actually be subtracted. Okay, then our long-term liabilities minus our change in long-term debt. And then we can add those together. And so our beginning of year total net assets would be the total assets minus those liabilities, which gives us $2,126,250. And so we can use that to multiply by the end of year rate minus the beginning of year rate. And these are supposed to be rounded as well. So we'll put the round function in. Okay, next we have the net income times the end of year rate minus the average exchange rate. So we'll say equals, grab our net income times end of year minus average for 17,640. Then next we have the dividends times our end of year minus the dividend rate. And so we have our dividends of 44,100 times end of year minus dividend rate. All right, and then we can use the sum here for 165,596. Then we'll list our beginning of year cumulative translation adjustment. And that was given here, 102,848. And we get an end of year cumulative translation adjustment of 62,748. So now we can come down. It would also like us to do the journal entry to record the translation adjustment for the year. So this will be a debit to equity, investment, and a credit to the end of year cumulative translation adjustment for the 165,596. The next part of this problem says that the following are selected financial statements accounts for the parent, income statement, balance sheet, statement of retained earnings, and statement of accumulated comprehensive income. Assume the following information: the purchase price of the subsidiary included an AAP asset related to land that the parent estimated to be worth 200,000 British pound, but more than its book value on the subsidiary's balance sheet. Confirm the balance of the equity investment account of 4,139,188 on the parent's balance sheet. And so they already gave us these accounts here, and we're really pretty much just going to go plug the information in. So we'll start with our beginning of year common stock. And we're going to reference out of the US dollars side now. So we have common stock of 115,500. Our APIC of 144,375. Our beginning of year retained earnings, 2,926,035. Then our beginning of year AAP. So we'll take the 200,000. I guess I can just do it right here in the cell, and multiply that by the beginning of year rate to convert it to US dollars for 290. Then the end of the year, beginning of year cumulative translation adjustment, we can reference up here the 102,848. Our equity income is given here for 652,680. Then our current translation adjustment of 165,596. And then our AAP translation adjustment. So over here on the side, let's do a little table for our AAP translation adjustment. And so we'll have the beginning of year balance, our amortization, the end of year balance, and then the AAP translation gain or loss. And we'll do euros, rate, dollars. And so the AAP adjustment is the 200,000 times that beginning of year rate of $1.45, and that gave us the 290. And I'm sorry, this should have been in our beginning of year. And then for amortization, there is none because this is land and the land is not amortized, which means our end of year balances just carry down. However, the end of year balance is $1.52. And so it's down. So if we multiply this 200,000 times our end of year $1.52, we can then see that the 304 minus the 290 gives us the AAP of 14,000. All right, and then we just need to grab dividends. And we'll put the negative sign so that it pulls down in the positive. And so we can do here our sum and then subtract out our credit, and we get that 4,139,188. And if I were doing this T account, this beginning of year cumulative translation adjustment would have been on the credit side rather than listing a negative number. So I think that might have just been a weird glitch in the software. And so then finally, we're using our translated subsidiary financial statements from Part A and the parent's financial data provided in Part C to prepare the consolidation spreadsheet for the year. Obviously, we're going to do the whole CD, but we'll start out with that C, where we eliminate the change in the investment account during the year. And so we already have, actually, what we really need to start with is pulling in the information for the subsidiary. So let's do that really quickly before we get ahead of ourselves with the CD transactions. So we're just pulling now the US dollar of these things. So our sales, cost of goods sold, gross profit, then our operating expenses, okay, then we'll come to the statement of retained earnings and pull that down. And our comprehensive income. We'll pull the 102,848. Our current year translation gain. Our 165,596. Then the end of year 62,748. Then our balance sheet. Grab our cash. Our PPE. Then our current liabilities. And pull those down. Then our cumulative translation adjustment. We have here 62,748. And then we can do a sum for that same 6,539,451. So now we can do the CD process, and so we'll go ahead and start with that. Our C entry, which if you remember from the previous chapters, is to eliminate the change in the investment account during the year. We'll start here with our equity income, and we'll reference up to the 652,680. Then we can jump down to dividends and grab the 66,150. Then for our current year translation gain or loss, we'll grab the parent company, the 179,596. And in the credit for the equity investment on the balance sheet, we can solve for that as our two debits minus our credit to get 766,126. So next is the E entry to eliminate the beginning balance by eliminating the book value portion of the beginning investment account. And so we can come up here to our beginning of year retained earnings. and grab that number, the 2,926,035. For our end of year, our beginning of year cumulative translation adjustment, we have, we don't want that to come down as a negative, so I'll put a negative sign and then reference the 102,848. Then down here, we also need to get our common stock and our APIC, so we'll say equals common stock. And it looks like we can pull that down because APIC is next. All right, and then that leaves us here plugging our beginning of year retained earnings plus the common stock plus the APIC minus our beginning of year cumulative translation adjustment for 3,083,062. And then next on the adjustment list, we have our A transactions to allocate the beginning of the year AAP by eliminating the remaining investment account. And so we can just reference up to B106. All right, and then finally we have the D to recognize the change in the PPE, APE resulting from the change in the exchange rate during the year. And so we can reference this AAP translation adjustment. And then we'll do totals here. And actually, I think because these cells are merged in between, it doesn't really like that. So I think we have to just manually add them all together. All right, and then that just leaves us with the actual final calculations over here that are consolidated. So for a lot of these, we're just adding the parent and the subsidiary together. And we can copy this down. And then on some of them, of course, we have to deal with the elimination entry as well. Copy that formula again. And then add these together, subtract out our debit. And our net income should be equal to the parent's net income. So I copied that formula down, but I shouldn't have. We should just reference the parent net income. For the dividends, we will add across the whole row. Which gives us the parent, so that's good. And our end of year retained earnings will be equal to the parent, 13,594,000. Then we'll add across the row for the beginning of year cumulative translation adjustment. For our current year, we'll add together the parent and the subsidiary, subtract out our debit, add our credit. And our end of year cumulative translation adjustment will be equal to the parent. Then we can come down to the assets and continue the same pattern. Copy this formula down. For equity investment, just remember that we have to go down all three of these rows, so subtract them all out. And so it should be 0, so that's correct. Same thing with the plant and property and equipment. We have 2 rows that we need to add in. So just be careful that you don't actually go straight across and forget the one below it. Then We're down to total assets. We can do a sum. For 27,092,108. And then we'll continue down into the liabilities. Copy this. Then our retained earnings is equal to the parent 13,594,000. Our cumulative translation adjustment is equal to the parent 76,000. And then we'll do a sum here of the liabilities, which matches our total assets. And then we're done.